I've been reviewing fourth quarter earnings these last few days, and I have to say that I'm pretty impressed with company reports. I've been concentrating on four of the biggest tech companies in the world: Hewlett Packard, Intel, Cisco, and EMC. Combined, these four companies sell a broad swath of information technology hardware, and their revenues are showing real improvement, as are their net income. You can see, if you look at the chart that I've created, that there was a huge drop-off in both revenues and net income during the fourth quarter of 2008 and the first quarter of 2009. But starting in the second quarter and especially strong in the just completed fourth quarter, revenues and earnings have had a huge surge off the bottom. In fact, year-over-year revenue growth for those four companies is 14%, and year-over-year net income growth is 56%. If you look at the S&P 500 as a whole, the fourth quarter was also a pretty impressive quarter. We're seeing earnings growth, and I think we're starting to see a little bit of revenue growth too. So it makes the case that we are having somewhat of a recovery. The question for me is, what are the drivers of this recovery, and how sustainable is it? At the same time that I've been looking at these fourth quarter earnings, the Fed last Thursday increased the discount rate. Now, this in itself is not a hugely important move, but it's symbolic. We're moving from a stage of dramatic easing, which supported financial markets and the economy, to a stage of tightening. President Obama is now talking about a deficit reduction committee. Now, it's just talk, and who knows how much they're going to get done, but it's indicative of the mindset that, a year ago, we were creating a $787 billion stimulus. Now we're talking about a deficit reduction committee. So these massive federal monetary and fiscal policies that really stimulated and spurred the economy and financial markets are now starting to be wound down. And the question is, can the market survive without them?